So imagine you're a kid and you bought a candy bar for a dollar. Years later, you decide to sell that candy bar and it's now worth $3. So you make $2 in profit. And yes, the government wants their piece of it. The government calls that a capital gain. Now here's where it actually matters, because there are two types of capital gains and the difference could save you thousands, if not hundreds of thousands of dollars over the life of your investment. Number one is called short term. So if you buy and sell a stock, an ETF, a bond, any asset within 1 year of purchasing it, IRS treats that profit like regular income. So depending on your tax bracket, you could owe as much as 37% on that profit. Ouch. The other type is long-term capital gains. You hold your investment for more than 1 year before selling it, you get a much better tax rate. We're talking 0, 15, or 20% depending on your tax bracket. That is one of the most powerful tax breaks available to retail investors like you and I, and so many people either don't know about it or don't take advantage of it. If you're single and your taxable income is less than $49,450 per year, you pay nothing, 0% in long-term capital gains. If you're married filing jointly, that number jumps to $98,900 in taxable income. If you're single, you'll pay 15% on long-term capital gains if your income is between $49,000, if your taxable income is between $49,451 and $545,500. And if you're married filing jointly, the 15% bracket includes taxable income between $98,901 to $613,700. 20% rate is reserved for single filers making anything over $545,500, and if you're married filing jointly, anything over $613,700. If you fall in the 0% bracket, you can literally sell investments at a profit and owe $0 in capital gains taxes. It's not a loophole, that's the law, and it's designed to help people build real wealth. Now here's where people mess up. They panic sell during a market downturn, or they trade in and out of stocks constantly, and they accidentally trigger a big short-term capital gains tax bill that they weren't expecting. The quietest wealth building strategy: hold longer, not necessarily forever, but just long enough to cross that 1 year threshold so you get the long-term capital gains rates. And the easiest way to avoid capital gains tax altogether is to invest in a Roth account. So this can include a Roth IRA or a Roth 401k. Those accounts, your investments grow as well as your earnings and any dividends absolutely tax-free. No capital gains tax at all while your money is in there. And if you're doing it in a traditional IRA or a traditional 401k, those capital gains rates are tax deferred until you start making withdrawals in retirement. That's why I always say to fill up your tax advantaged accounts first and then worry about